The Property Bulletin by London Property, the home of superprime.
Will the mansion tax become a terrace tax? Here are some key points. From 2028, homes worth £2 million plus will face an annual surcharge of £2,500 to £7,500. Although only around 200,000 homes qualify, many are ordinary London terraces, prompting warnings it may become a terrace tax. Sellers are already repositioning prices to avoid the threshold. Buyers are shifting towards properties safely below the levy. Agents report renewed activity and optimism, particularly around the £1.25 million mark. Older homeowners, who are asset-rich but cash-poor, may be pushed into selling sooner. Experts say decisions should weigh the annual charge against the high costs of moving, with tax deferral options likely to be explored in upcoming consultations. First-time buyers may be left behind. No new support schemes were introduced. Rising rents, up 51% over 10 years, plus frozen income tax thresholds mean younger buyers face even steeper savings challenges. Buy-to-let may come under more pressure. From April 2027, rental income tax rates rise by 2%, accelerating the exodus of private landlords. Tougher legislation and shrinking returns are pushing investors to use company structures instead. There is one small win. Rent-a-room relief stays at £7,500 tax-free. 2026 changes to agricultural and business property relief. What do you need to know? From April 2026, the current APR and BPR rules will be replaced with a single £1 million 100% relief allowance per person. Any qualifying agricultural or business assets above this £1 million cap will receive only 50% relief, increasing potential inheritance tax exposure. Who will be the most affected? Farming families with land and business assets exceeding £1 to £2 million. Rural business owners with mixed trading and property income, estates where assets are held mostly by older generations, and diversified farms, commercial activities, holiday lets. All this matters because these reliefs have long protected family farms and rural businesses from large IHT bills. The new cap could force some families to restructure or sell assets to meet tax liabilities. What this means for estate planning: review estate values and identify exposure above the £1 million allowance. Reassess how assets are owned between spouses and family members. Check whether trusts or company structures remain effective. Consider early gifting and succession planning. Ensure wills, partnership agreements and shareholder arrangements are updated. Some helpful points. Unused relief can be transferred between spouses, giving couples up to £2 million at 100% relief. Existing APR-BPR claims before April 2026 remain unchanged. Some trusts may still qualify, but within the new allowance limits. What action is required? Farmers, business owners and landholders should review their estate plans now to protect assets and prepare for the 2026 changes. Green mortgage options have grown sharply, from just 4 products in 2019 to 90 today, offered by 48 lenders. These deals either reward buyers of energy-efficient homes, typically EPC A or B, or offer favourable borrowing terms for green home improvements. What makes them attractive? Green mortgages often come with lower rates, cashback or boosted borrowing limits. Many of the best deals in the market now fall under the green category. On the 2nd of December, the second best mortgage rate in the entire market was a green deal from Nationwide at 3.6% plus cashback. For remortgages, Lloyds also offered one of the top rates. For first-time buyers, Danske Bank and Lloyds were joint market leaders at 3.64%. In weekly November data, green mortgages made up 24 to 52% of the top 25 products. Do top-rated lenders offer these mortgages? Nationwide, cashback plus green borrowing options. Skipton, additional borrowing for green improvements. Principality, no green products. Nationwide stands out as the only lender combining top customer satisfaction with strong green options. Rates for top products sit around 3.64 to 3.69% with fees around £999, plus incentives such as £250 to £500 cashback from Nationwide, Lloyds and HSBC. Danske offers rate discounts for EPC-rated homes, and there's enhanced borrowing capacity for upgrades. Landlords can also access green mortgages for buy-to-let. 31 products are available from 28 lenders, including Barclays, HSBC, NatWest and Virgin Money. Incentives mirror residential deals, lower rates, cashback and extra borrowing for improvements. The bottom line: if you already own or plan to buy an energy-efficient home, a green mortgage could genuinely offer one of the best rates in the market. They're no longer a niche add-on, they're often among the leading deals. UK Real Estate 2026. Here are some key takeaways. Budget shake-up. New super council tax on £2 million plus homes from 2028 and higher landlord taxes from 2027 will likely cool high-end demand, push some owners to sell and drive further rent increases. No stamp duty reform or help to buy replacement may slow first-time buyer activity. Commercial recovery. Offices show early signs of stabilisation. Hybrid working is settling at 3 to 4 days in the office, boosting demand for quality workspace. Flexible and co-working environments continue to grow. Rental market tightens. Private landlords are exiting due to rising taxes and regulation, reducing supply as demand peaks. Institutional build-to-rent and single-family rental models are stepping in, attracting strong capital flows. Life cycle living grows. Younger generations increasingly move through a new housing pathway, from student living to co-living, PRS apartments, suburban rental homes and senior living, reshaping development and investment strategies. Affordability strains intensify. High interest rates, stalled sales, rising build costs and stringent affordability quotas are slowing development. London is especially impacted. Without policy easing, affordability will remain the biggest challenge of 2026. Outlook. Success will hinge on adaptability, smarter capital deployment and embracing long-term rental models. Funding for specialist rental and low-carbon schemes is set to rise as the market adjusts. Chancellor Rachel Reeves may need to spend £4,900 to £7,550 upgrading her Dulwich rental property to meet Labour's proposed energy rules, which will require landlords to reach EPC rating C by 2030, currently E. Her home is rated D, earning £3,200 a month in rent. The EPC report suggests improvements such as loft insulation, floor insulation and solar water heating, which could save around £300 a year, meaning a payback period of more than 25 years. The case highlights wider concern among landlords. Critics, including the National Residential Landlords Association, warn that the policy will add significant costs and may push rents higher as landlords pass on expenses. Tory chairman Kevin Hollinray called the situation evidence of Labour's growing burden of red tape. The story follows recent scrutiny of Reeves for previously renting out the property without the correct licence, which she said was an inadvertent error.
Subscribe to our newsletter to receive our weekly bulletins and stay ahead of what's shaping the super prime property market.